Imagine an airline that recently has been seeing a drop in their profitability due to a problem that is called underutilization, which basically means that they're booking too many flights with too few passengers to fill the seats. What this means that our airline is overestimating the demand for certain routes, flying half-empty planes, and losing money on every trip. So what's wrong? Well, maybe our airline is not great at predicting how many passengers will actually fly on a given day or route. And the answer to this may lay in time series analysis. So what is a time series? Time series analysis is a specific way of analyzing a sequence of data points collected over an interval of time. So it consists of 1. Data of the same entity, like the number of air passengers that you can see plotted here. And secondly, it should be collected at regular intervals, for example per month, which is plotted here on the x-axis. So by a time series plot, we simply mean that the variable is plotted against time, which allows us to analyze trends, patterns, changes over time, and ultimately helps us make predictions. There are generally 4 main components of a time series. First of all, the trend, which is the long-term movement or direction of the data, indicating growth or decline. Then seasonality, which are regular periodic fluctuations that occur at fixed intervals. Then we have cycles, which are fluctuations that are not over a fixed period. So think here of business cycles that can happen over years or even over decades. And then we also have irregularity, which is the residuals or the noise. It is basically all the random and all the unpredictable variations in the data. So you remember our airline. Well, an example time series for our airline may be an upward trend because maybe more people are flying every year. Secondly, there may be seasonality on top of that because there may be peaks in holiday seasons. And on top of that, there may be some variation or noise or some random fluctuations in the data that we really cannot predict. And our time series may not even have cyclical trends. So it really may be that this is what our time series for this airline looks like. All that to say that some time series may not be affected by all types of variation. So we may have a time series that only shows a trend or only shows seasonality without really a trend. And that's why it's very handy to try to decompose the time series, because we're, for example, not trying to predict irregularities in the data. We're trying to look at overall patterns that we see. And that's why it's very useful to try to isolate these. And when we try to decompose time series, we generally can break it down into seasonal data and non-seasonal data. So seasonal data is something like the average monthly temperatures, which would be higher in a certain month and then get lower again, or a number of flu cases, which will peak during winter months, or even electricity consumption, which will have daily, weekly, and annual seasonal patterns. As opposed to seasonal data, we have non-seasonal data. Here an example is shown, which is the number of important scientific discoveries, which generally will not follow seasons. Other examples may include the global population rate, which isn't tied to seasons, or the Bitcoin price, which is very volatile but doesn't follow a consistent seasonal pattern. Well, unsurprisingly, non-seasonal data consists of the same things as seasonal data, but without the seasonality aspect of it. So we're just looking here at the trend and irregularity. So just to quickly recap, time series analysis, it basically is data of the same entity that is collected at regular intervals. It consists of 4 different things: the trend, seasonality, cycles, and irregularity. And generally we distinguish between seasonal and non-seasonal data.